Hello, everyone. Welcome to this TradeStation webinar. My name is Jesus Nava. I'm the Director of Client Training and Education for TradeStation Securities. It's always a pleasure to be here talking about TradeStation, specifically today, which is a day where we're going to talk about options and complex option strategies that you can apply in everyday market activity. Before I pass the microphone over to our guest speaker today, who is Brandon. Brandon, hi, how you doing today?
I'm doing
Great.
pretty good.
Awesome. So today's title is Bull Call Spread, Balancing Opportunity and Risk. And as I said at the beginning, Brandon is going to come on and explain the option strategy for us. He's our guest speaker, and I'll pass the microphone over to him in just a moment. But let's go ahead and go through some of the disclosures of this presentation. Keep in mind that every symbol and idea that we talk about is for educational purposes only. These are not recommendations of TradeStation. Also, active trading is not suitable for everyone, and past historical performance is no guarantee of future results. For additional information, go to www.tradestation.com/important-information. We have all the disclosures there about futures, disclosures about options. So I just wanted to make sure that everyone is aware of that. Also, Brandon is not affiliated with TradeStation, although we enjoy his presentations and we love to have him because he has a lot of expertise in the options trading market. Just wanted to state that he's independent, and but he brings to us a lot of educational value. So, Brandon, I'm going to let you do your own introduction. Thank you for joining us today, and I'll pass the floor over to you, okay?
All right. Thank you very much, Jesus. I appreciate it. My background, just real quick, I've been trading and investing for myself for many, many years. I got involved in late 1990s as a trader for a brokerage, and then moved into hedge fund private trading. I'm no longer licensed, so I'm not able to give financial advice like that. So what I do is education. I trade for myself, no one else. And I was asked to come in and discuss some of the trade strategies that are available to you as traders and clients of TradeStation. Anyway, for today, I'm just going to keep going on. If you have any questions, raise your hand or type in the chat. If you have that question, I'll try to answer as best I can. But we're going to talk a little bit about the Greeks, which are risk parameters that are telling you how things influence the pricing, either possibly potential profits or potential losses in premium for the options. So we're going to talk about how those affect us, and especially how we're going to be dealing with those when we're looking at this particular strategy, which is the bull call spread. So we're going to go over those fundamentals of that strategy, as I mentioned, talk about what they are, why we might want to use them, when we might want to use them, and do some practical examples looking at the markets. Anyway, we're going to perform utilization or platform utilization. I'm going to use the workspace that is available to you. If you're a TradeStation customer, you can go into, actually anybody can go to the Options Education Center on TradeStation.com, and the workspace is downloadable. You can actually access it along with some instructions as well, and you can import that into your TradeStation to kind of follow along with what I'm doing or practice in a simulated mode on your own whenever you like. So that's kind of neat. I'll go through how that works. And we're going to talk about order management, how we would execute those using OptionStation Pro, how we might be able to protect those positions as well. And of course, I'll answer questions along the way. So again, if you got to ask away, I'll try to keep this on point, and we only have limited time, so I'll get through as much as I possibly can and hopefully leave you with a good understanding of what bull call spreads are and when to use them. So when it comes to measuring risk in options, we have what are called the Greeks, and we don't need to focus on all of them necessarily. The major ones I'm going to talk about, one that most people focus on a lot, is called delta. And delta D is direction. So it basically tells you how much your options premium is likely to change either up or down when the underlying security moves up or down. And when I say underlying security, these options could be traded on stocks, ETFs, indexes, or even futures. TradeStation, they recently had an options on futures webinar. You can also, again, look on the Options Education website for more of those details. I'll bring that up a little bit to show you where everything is too. And basically, so delta, if let's say you're trading an option on the S&P index, if the index moves up by 1 point, that delta tells you how much the underlying premium would move on your option by that same amount. It wouldn't be one for one necessarily, it would be whatever the delta is. Gamma is an acceleration factor. So say, for instance, you're traveling at 60 miles an hour in your vehicle, and you decide to put a little more pressure on the juice pedal, right? So you go a little faster. Well, that's what gamma is. Maybe now you're traveling at 70 miles an hour. That means your distance traveled would be 70 in 1 hour, not 60. Well, gamma is that acceleration factor of 10 miles an hour in this case. So gamma is the rate of change that delta will go through, again, when a 1 point move on the underlying occurs, either up or down. So we have delta for direction, gamma, the acceleration factor of delta. Then we have time, theta, T for time. And I always equate options to ice cubes. You know, an ice cube, as soon as you remove it from the freezer, it begins to melt. And a large chunk of ice will melt slower than a small chunk of ice, a sliver. Same thing with options. An option with a large amount of time will melt or decay in time value slower than a small time left until expiration. Time value in options is not linear. It doesn't go straight down even every single day. It accelerates, especially in the last 30 days prior to the expiration. So you get this curve effect in time value, and theta is how much your option will decay in time, or in value, excuse me, the premium will decay for 1 day passing in time. And that does include weekends and holidays. And finally, we have vega, or volatility. We actually use the symbol kappa, which is the Greek letter, because vega is not a Greek letter. But V, vega, volatility, that is how much premium will change either to the upside or the downside when you have a change in volatility by 1%. And volatility can change independent of price movement. So you got to be careful of that as well. And in order to understand options properly and what you're really risking, you need to understand these Greeks. The only one I didn't include here is rho. Rho is a change on the interest rates. So when the Fed raises or lowers interest rates, it actually affects option pricing as well. We don't focus on that as much because it doesn't change as rapidly as these others do. So when it comes to options, I like to keep it pretty simple. So basically, there's only 2 types of options, and there's only 2 things you could do with them. You could buy them or sell them. That's it. So if you buy a call, you're bullish. And what we'll see here is we get a green arrow. If you're selling a call, you're bearish. If you buy a put, you're actually bearish. If you sell a put, you're bullish. So whenever you see a green arrow, that tells you the direction of that action, or I should say the direction the trader intends to profit from the underlying security. So if you buy a call, the trader would potentially profit if the prices were to go up, or if they sold a put, same thing. They would potentially profit if prices were to go up on the underlying. Well, that means they will have a positive delta. And if you have a down arrow, that means you would potentially profit from a downward move, so you'd have a negative delta. Well, you'll see right here, almost everything is equal and opposite with options. You know, you buy a call bullish, sell a call bearish. So buy a call positive delta, sell a call negative delta. If you have buy a call, you're buying an ice cube, you don't want that to melt. If it goes down in value, you lose money when you buy something. If you were to sell something, you do want it to decay in value so you could buy back cheaper if need be. That's why you see a negative theta for calls and a positive theta for selling calls. And vice versa. Well, not vice versa, but actually on the puts, again, you have a negative theta for buying them and a positive theta for selling. And then volatility, if volatility rises, it increases values on options typically. So you have positive vega for buying, either a call or a put. So on the buy side, the only thing that's different between these two is the delta. Because if you buy a call, price is going up is good, down is bad. It's opposite for buying a put. But the theta and vega are the same for buying a call or buying a put. Same thing on the sell side. If you sell a call or sell a put, you have positive theta because you want that to decay. You sell something that's expensive, you want it to decline in value so you can buy it cheaper. And if the volatility were to drop, that would also reduce the value, allowing you to buy back cheaper if you need to buy to cover or close your position. So what we can do with trading what we call spreads, a lot of people just do one option. or single leg option trading. If they think markets are going to go up, they buy a call. If they think it's going down, they buy a put. The problem is you're exposed to a lot of risk. So to control the risk a little bit better, which by the way, that's the only thing within your control when you're trading. You cannot control whether you'll win or lose. If you can, let's talk, right? No, you can't. It's impossible. The only thing within our control as traders or investors is how much risk we're willing to accept, how much we're willing to lose if we're wrong. And even then, there might be, especially with stop losses, it may go a little beyond what we expected. There's no guarantees, obviously. But we could start to control the risk a little better by using what we call multi-leg option strategies or spread trades. If we combine some of these, positive and negative, delta, theta, vega, whatever it may be, we can offset them and reduce their effect on our positions. And that's what spreads are all about, controlling the risk. So we get a lot more flexibility in our trading when it comes to trading option spreads. And you could profit from different characteristics in your options. For instance, if I just go out to OptionStation Pro real quick, I have Acadia Pharmaceuticals up. It's just random. I happen to have that up there for whatever reason. And let's change the columns because I definitely have way too many things up there. This is nice. I can customize a lot when it comes to these columns on OptionStation Pro. So we want to take a look at the Greeks. We'll add delta, gamma, where's theta? Theta and vega. So we got the major Greeks there. I could have put in row too, but there's no point. I don't need it right now. So let's just say we were bullish on the security and we buy the 18 call that I happen to select right there. Let me go back to the option chain. There we go. Click on trade. And here we have, well, a delta 59.85. Okay. And I'm not sure where you're seeing the delta showing a table with the D small b, because I'm seeing delta right here. And if I go over to the analysis page, I have delta spelled out everywhere. So not really sure where you're seeing that, maybe on the actual other platform itself, rather than looking at the OptionStation Pro. But as far as I can see, delta is being shown as delta. Anyway, I have theta being shown here as well. And I should have, yep, there's vega, theta, all the Greeks are there. And basically what I'm doing right now is I'm exposing myself to directional risk. I'm bullish because I have a positive delta, meaning this profits if the stock goes up, it loses profit if the stock goes down. I have volatility risk. You may have beta weighting checked. Oh, that's a possibility. Yeah, if you're using beta weighting against something, that's what it is. If that's what you're seeing, yeah, I understand. Thank you, Keith. If that's what it is, that's what it's doing. It's doing what's called beta weighting against another security. I don't want to go too much into that right now because it does have to do with this, but you're basically weighing it against another security and how that security moves. But if that's the symbol you saw, you just have to take off the check mark right there on beta weighting at the top of OptionStation Pro. And then you'll get your regular delta. That's what we want to focus on. So basically we have delta risk because if prices go up, this makes profit. If it goes down, the option loses. We have time value risk. As time goes by, every day we lose $1.75 in value from that premium that we're paying, right? We want this to go up in value, not down. And volatility, 284. We have volatility risk. If the volatility rises, this option profits potentially, but if it drops, the volatility drops, the option value could potentially go down. And I'm not seeing the gamma right now, but again, that also will affect us to a certain amount. So if we want to control those risks, it's nearly impossible to do that with a single option. But as we go on, I'll show you how we could do that. When we deal with spreads, we can actually fine tune the risk and not necessarily eliminate, but minimize the risk that we have on some of those factors: time, volatility, direction, whatever it may be. So combining options let us do that. And we can also do multi-directional trades. You could do something that's bullish, combine it with something that's bearish, right? Buy a call, buy a put. That's a multi-leg strategy. It's called a straddle. Or if you think prices are going to stay within a range, you could trade an option spread and profit from prices staying within a tight range. When it comes to spreads, it doesn't matter what spread you're looking at, you have two parts of the spread. The first is called the anchor leg. And the anchor leg is the one that really drives your profit. It's the one that drives your strategy. So it determines whether the strategy is bullish or bearish, or possibly neutral. Okay, so that's the first leg that we usually need to decide. And it's based on what we're deciding to do with the underlying security, what we expect the underlying security to do. I like to keep things relatively simple with options trading. And that's because it can become very complicated if you allow it. We don't want to. Okay, so starting off, I will usually look to see what is the underlying security doing. Do I think it's going to go up in value? Do I think it's going to go down in value? Do I think it's going to go sideways? Then I take a look at the options and I decide, are options expensive or are they cheap or are they relatively fairly priced? Well, if going back a little bit here, actually, to this, just without the deltas and all that other good stuff. If I understand that if I do my analysis on a security and I decide that this security is going to go up in value, well, I know I need to choose the green arrow as my anchor leg, or I need a bullish strategy, right? So it's either buy a call or sell a put. Those are the two green arrows. Second step would be to determine whether or not the options are expensive or cheap. If something is expensive, you sell it. If something is cheap, you want to buy it. Now, there are going to be some other factors to this, but I'm trying to simplify this as much as possible. Let's say the options are relatively cheap, volatility is relatively low currently. Well, then I choose the right strategy. That's step 3. So step 1, which direction do I think the underlying security is going? Step 2, what's with the option pricing? Is it expensive? Is it not? Is it fairly priced? Well, if we are bullish on the underlying security, options are relatively inexpensive, volatility is relatively low, I know I want to buy a call. That's the best choice out of those for my anchor leg. And that's number 3, choose the right strategy. Well, we'll see how we can control that risk by adding a piece to that anchor leg. So the other leg is called the offset leg. You have the anchor leg and then the offset leg. The anchor leg sets the strategy. The offset leg helps to reduce some of the risk that you face from the Greeks, either through time, direction, volatility, or whatever. Okay, so there's 2 basic types of spreads. And we're going to talk about the first one, which is a debit spread. A debit spread, you actually have to pay a premium to enter. It's a debit. The premium is your maximum risk. That's the nice thing about it. So if I pay for an option, I think of options as a coupon, but not like a coupon you get for free in the newspaper. If you remember years and years ago, I'm dating myself here, but there used to be things called the entertainment booklet. They were used as fundraisers. You used to buy these big, thick booklets, like 700 pages, and there's a card in there, entertainment card, and coupons you could use. And I think they were about $49.95 for the book. And basically, if you bought that book for the fundraiser and never used the coupons, what'd you lose? What you paid for the book. But if you use the coupons, you may have gotten more value out of those coupons than what you paid for the book. It's the same sort of thing with the option. If I have a call option and I'm buying that call option, if I never use that call option, the most I will lose is what I paid for that call option. Now, I'm not including fees and commissions on top of that. Obviously, those are extra. But the premium I pay for a debit spread to buy that option spread is what I could potentially lose. That's the maximum. Now, my potential reward, hopefully, should be larger than that risk with a debit spread. The alternative is a credit spread. We're actually receiving premium. It's kind of like an insurance policy. I just bought a new vehicle and I insured that vehicle, so I pay a premium to my insurance company. If I never wreck my vehicle, never have an accident, knock on wood, well, they get to keep my premium, right? So sellers of credit spreads are selling insurance, right? If the security drops in value, they'll have to buy it at the value it was before it was wrecked. But if the value does not go down, then the seller of that credit spread gets to keep the premium once those options expire. Well, the difference you'll see in that is that the risk can be larger than the amount of profit you're potentially gaining from the position. But these can also be controlled. Just because the maximum risk when you buy a debit spread is the premium, it doesn't have to be that. You could set up stop losses to limit the risk that you, or minimize, not necessarily limit to a certain amount, but reduce the amount of risk if things go against you. Same thing with the credit spread. You can set up stop losses to help reduce the potential of loss or the amount of loss if things were to go against you. And that's the nice thing about TradeStation and OptionStation Pro. You can do that in the program. So we're going to focus on the bull call spread, as I mentioned. And this is a bullish debit spread using calls. That's it. And as you can see from that, this is called the risk profile, to be able to kind of see visually how much you would potentially profit or lose when it comes to that particular spread. It's created by buying a call option at a lower strike, and at the same time, simultaneously, you sell a higher strike call. Okay, that's it. Buy a call and sell a call. Going back to our chart, that's going to kind of offset. Remember, we have positive delta for buying the call. We have negative delta for selling the call. Now, they won't be the same amount. So that way you'll have some positive delta left. We have to have something to potentially profit from the upward move of the underlying security. But we're also going to be offsetting some of the other risks, which is nice. So this will profit if the underlying price rises, the underlying asset rises in price. And the premium collected from the short call does reduce the amount of premium you have to pay altogether for this position. Remember, we go back to my example that I was using here, and I was looking at buying this call on ACAD, and it is strike 18, and the mid price, I'll use the natural right now, is $2.40. That means you would have to pay $2.40 per share, but you got to remember, this is 100 shares. You go to minimize, and there we go. We can actually see the risk profile here. So by buying this option, you're paying actually $2.23 per share. And it's $223 total, or actually it looks like it's rounding down to $222.50. That's your maximum loss, what you pay for the option. The potential profit, if you buy a call, is unlimited, because theoretically, this stock could go up forever. In reality, it only does that when you're short. I'm just kidding. Seems that way, though, doesn't it? Anyway, now if I go back and add another leg to this, let me just remove this one so it doesn't pop up both. And I'll remove it here as well, just to keep it clean. We'll go back to our options and select, once again, the same 18 call, but I'm going to hold down the control key, and I'm going to use, let's say, go up to 25, and I'll sell that call. So now we're creating a vertical spread, in this case, a bull call spread, where we're buying the lower strike at 18, selling the higher strike at 25. You'll notice we still have a positive delta. It wasn't 59, but it is still positive. As a matter of fact, the delta went up to about, we'll call it still 59.60, just for that one option. You can see the difference between them. If you bought that one option, it was 60 for the delta. Now you're at 45. So we've lowered our delta a little bit, but we also lowered some of our other risks, which is going to be good. So comparing the two, let's see, if I go to analyze, there we are. And actually, I do want to go back. I have that one set, I believe. So if I remove, I should be able to do this. Analyze. There we go. So I've got them separate. So here I go. I take off the vertical spread. There we go. And there's the single option by itself. And you can see the risk profile for just buying the option versus, and again, the max loss, the delta 60, Vega 284, time value or time risk is $1.50 roughly, versus the vertical spread or bull call spread. Take that off and go here. And now we have a smaller max loss. The max loss for just the call option by itself, the 18 call, was $260. Now we've reduced that to $190, which seems really good. We reduced our risk. But when you reduce risk, you also reduce potential profits. Okay, you saw it was infinite potential profits. We now have a cap at $510 maximum profit. which is basically the difference between the two strikes I selected minus the premium we paid. Also, the delta has dropped. We had a delta of 60, it's now only 45. We don't profit as much, but we still profit if prices were to move upwards on the underlying security. We've reduced the volatility risk. We were at 284. If volatility dropped, you would lose that 284 from the premium. We've dropped that to 113. So now we have lowered volatility risk. We also have lowered our time risk. It went from 150 down to 91.91, excuse me. So we were able, by just adding that extra leg, we did reduce our risk, we reduced our cost, we reduced our profit. And when I say reduced our risk, we reduced it based on the directional risk we reduced the time risk, and we reduced the volatility risk at the same time. That's pretty neat. That's what you do spreads for, to be able to fine tune what you're looking for. Would that stock potentially go up forever before that option expired? No, probably not. What we can do is use our technical analysis to figure out where is that price not likely to go beyond before that option expires. And if we sell options above that level, then we're really not capping our profit too much. We're going where it expected to go before the option expired. For example, again, if I go back to TradeStation and there's ACAD, we could see that it actually showed up as one of my scans. Again, I don't have it open, I believe. Let me check now. Shoot. If I go out, I'm not sure what it's going to pop up here. Let's go to TradeStation. And I wanted to go to this and show you anyway. If we go to Learn, Options Education, right here. While that's loading again, I'll just go back and show you there's a scan, bull call spread scan, and there's also a radar screen that we could use with the parameters to find potential bull call spread opportunities in real time, which is pretty nice. So again, ACAD came up on my list. I see on the monthly chart, it looks like it's trying to go back into weekly chart, starting to go back, not quite in a bullish trend yet. So I don't know if I'd select this one. And same thing on the daily chart right now. But again, looking on this chart, I don't know if I'd select this one. I can just go down to the next and just keep going until I find what it is I'm looking for. I am looking for a bullish security, obviously, that is not near the end of its run. I don't want it near some sort of resistance that's going to turn down. It's potentially going to continue to move to the upside. I might want to wait to enter my bull call spread until prices have pulled back into a support level where it's likely to bounce. And I could just run through the results of my scan. As I said, I ran it just before we came in here today, 1:56 p.m. today. How did I got to the scan? Well, again, the scan is available for you to download. It is, I forget what it was written on. It was a while ago, but if you go into customize, you can actually see the scan. There it is. It's based on volume of the security being high enough so it's liquid. We want no penny stocks, so we're looking at over $15. We're looking at securities that have been bullish for some time and technically are also showing bullishness, but not overbought. Because again, if they're too overbought, they may turn to the downside. They're also not oversold because they're not looking like they're pulling back too much. And their implied volatility is going up as well. So you can go into that. Like I said, the workspaces are available for you right here, the Options Education Center. Oh, there we go. Now I can copy this. And here is the link right there for everyone. So you go here and you'll find there's quite a few of them out there already. But if you go scroll through, again, this will be available as far as the webinar very soon. And if you go to, there we go, bull call spreads, there it is, download workspace. So you can get that all available to you in that download very easily. Just click on the link. And the directions are there as well. So yes, it's a custom scan that we created to help you with identifying those opportunities. Same thing with the radar screen as well. So let me just take this example, for instance, AEM. This looks pretty bullish on a weekly basis. And on the daily, might be pulling back soon, but we'll see. As of right now, I'll zoom in a little more. I may not want to put in the bull put spread right now because prices have already gone up quite a bit already. But if it does pull back, looks like the $70 area might provide an area where prices broke through a prior resistance, they may end up putting in a bounce there again. So if I'm looking for prices to come back down there at $70, I could potentially do a bull call spread. Now, how far will I expect it to go? Again, I could do more analysis on this to figure out where it's likely to go. Even if it just returns back to 76, let's see what we could do with a bull call spread. I go to OptionStation Pro. This was what, AEM. That's right. I already had it linked. Notice I had the global symbol link right here. And Jesus has a bunch of master classes on this, as well as getting started if you're not sure how to use some of these tools on TradeStation. So there's a lot of education there for you. But I linked it already globally, so I can go out to my options. And because this is a debit spread, I mentioned about time decay. Now we are reducing our time decay by a bit, obviously, by selling an option with buying an option. However, anytime I do a debit spread, I really don't want to go within those last 30 days until expiration. The reason why is the acceleration factor of that time decay. It gets much, much greater the closer you get to expiration. Within the last 30 days, it really accelerates. So to avoid that, I usually buy more time. So I like to look around 90 days, 100 days. Well, on this one, we do have November, which is 114 days until expiration. And typically, again, you have to set your own rules and decide what's right for you based on your strategies and your accounts and your strategy or techniques of trading. But I like to make sure that I get to my targets and exit the position, potentially for a profit, but if I need be for a small loss, when there's still more than 30 days left until expiration. So I want to enter with roughly 90 to 100 days, exit with no less than 30 days till expiration on debit spreads, on these debit securities. If it's credit, that's something different. But this helps me reduce a lot of the time effect or time decay that I would have on these options. And you can see that here. The theta or time on a 75, actually, we're looking at the 70s right there, it's only 3 cents. If I go something a little bit closer in expiration, 23 days, 70 has 5 cents. Now, it doesn't seem like a lot, but it actually adds up and it grows much faster every single day the closer you get to expiration. But even from here, again, I'm paying a little more for the option because there's more time. That gives me more time for the position to work in my favor and this underlying security to move either in my favor or against me, but it's not going to hurt me as much by waiting as long. Whereas if I buy the wrong options that have less time left, it could hurt me because that time decays. It's a faster ice cube to melt. So again, I could buy the 70 and we were looking at going maybe to 76 on the top side. We can either use 75 or 80. I'll choose 75 and sell the 75. It lets me, there we go. Unfortunately, I clicked one twice, so I'll remove. Oh, wait, no, I had the September still on there, so I got to remove that and buy the November. There's our vertical spread. And I'll use the natural spread right now just to make it even or easy, or I could use the mid, but the natural spread will take the ask price for buying, the bid price for selling, and it's just good for practice. If you do actually trade a spread, you could try to go closer to the mid price. There's no guarantee you're going to get filled, though. The mid price is in between, meaning you're trying to get a better price than what the market is offering right now. You need someone who's willing to fill you in order to get your orders filled. And it's a better price, as you can see, 280 versus 310, but the probability of getting filled might be down. It might be lower. So you just got to take that into account. If you want to get a better price and you're willing to wait, that's fine. Now, I mentioned I'm not willing to get into this until prices get closer to my entry of $70. I want it to come down and bounce off that 70. So this is kind of neat. I don't know exactly what price it will be then. I can guesstimate, and we could actually go through that with the analysis right here. Let's say it takes about a week to get there. I go ahead and change my chart here to do some of the analysis. And we have expiration. I'm just going to do 1 day for now. There we are. And this is set at today. See, it shows 114 days until expiration. Let's just go forward a week. Something like that. It's about right. So that's what our risk profile looks like currently. This yellow is at expiration. Okay. So what if the prices do end up dropping down to 70? Well, I'm going to go plot 2 right here. So now we're doing these price slice numbers based on 1 week from today, or whatever I set it at. And I'm going to change this to 70. There we go. And the value will not be $310. That's what it is right now, because right now the 70s, remember, price is currently trading at 75.16. That means that both of these options are currently in the money. Well, if it drops down where I expect it to about $70, the value of that spread will only be about $200, which is still potentially fine. That means I won't have to pay $310 to enter. My max loss will not be $310. It would only be $205 or $201, roughly. Again, it's not going to be exact, but it's roughly that. So how do I wait to get into that price? Well, I change this to market, because again, I could also use limit. Let's say I do only want to get in if it's about $2.05 max. I can do that. Make this good till cancel and say, you know what? I don't want to enter this spread until the price of the underlying, in this case, I use an activation rule tool. This is kind of neat. AEM, the price of that stock needs to go down or equal to $70. And I'm not going to go into the details here, but there's a couple things you can do to make sure you're not accidentally put in early, what they call a late print. You can do what's called double trade tick within the NBBO. Basically, there has to be at least 2 trades that occur within the national best bid or offer at $70. So I click OK. And when I click place order, that price, 205, is my limit. I will not pay more than $2.05 or 205 total for that spread. And I will not enter this order until the price of that security, AEM, goes to my $70 level where I expect it to bounce. How neat is that? So I'll go ahead and place that in a simulated mode, and it's in. That's it. Make sure. Okay. Again, I was able to reduce the risk, first of all, by getting in when I want to, not having to be in front of the computer to do it. And I specified the price I want by using a limit order. I could have used a market order, just take whatever price was available, knowing it's roughly going to be a little over $2 to get in. And I could also evaluate this to see if I get in at about $2, roughly what would be the target, or sorry, what would be the potential profit and risk in that particular position. So this is kind of powerful, the fact that I could do all that kind of stuff. And again, we have those scans available to you absolutely free in the Options Education Center. You just download the workspace with the scans involved. So getting back to the bull call spread, basically, this is a bullish spread. Profits when prices move to the upside on the underlying security. It's done as a spread to reduce your cost, number one, because selling a call lowers the cost of buying the call. It also reduces your risk based on directional risk. It reduces time risk and reduces some of the volatility risk, but it also reduces the potential profits. It caps it at a certain amount. If prices go beyond that strike price of the call that you sell, you don't participate anymore in the profits. That's it. You only participate up to that point, the maximum. So basically, the maximum loss on a bull call spread is the net premium that you paid to enter the spread. The maximum profit, I mentioned this as well, is the difference between the 2 strikes you select minus the premium you paid. Okay. And this is not including any fees or commissions you pay on top of that. The break-even price, okay, this particular spread needs prices to move a certain amount before you start making a profit. You got to cover the cost. It's basically the long call strike, the lower strike, plus whatever you paid for the position, the premium. That's all. Another question came in, assuming the whole spread is either executed or not on the order. Yes. You could do it as a single leg, but the problem is you would have it. The best way to do it would be as a two leg. Yes, a multi-leg option order being put in. If you try to do them single leg, if you're not a higher level options trader, you may not be able to put in the short side by itself unless it's recognized as part of a bull call spread. And you do have a lot of risk when it comes to shorting a call. Theoretically, shorting a call by itself is probably the most risky options trade you could possibly do, because you're selling a call guaranteeing that you will sell a underlying stock at that strike price, no matter what price that stock gets to, or again, index or future, whatever it may be, ETF. And the prices could go up at unlimited, infinite, right? So it's most likely the best way to put on the bull call spread is all at once. Yes, the long and the short together, rather than trying to leg into those. Now, this is a little bit different than trying to buy a stock and do a covered call. The covered call, which is a strategy a lot of people do, they sell a call on stock that they already own. That's fine. But if you don't already own the stock, doing a bull call spread to participate on the upside move in the particular security gives you the opportunity to enter in at a lower cost than buying the stock or buying the ETF or even buying the future. Again, you could do these on options on futures. So the cost basis is smaller. Potentially, you could have a higher percentage gain as well when you compare those two, those particular strategies. So the risks, again, we got to know the risks that we have. Can I review the spread in the position window? Absolutely. Yeah, I'll go over that. But when it comes to bull call spreads, there is limited risk, but there is risk. Okay, so the maximum loss is limited to what you pay for the premium. The volatility, if it rises, I'm sorry, that's actually a benefit. If the volatility rising is a benefit because it has positive vega, right? We go back to our spread that I was looking at right here. We see the vega. Oh, that's because of where the prices are right now. This is actually out of the money. So if I change this, remember, I'm not looking to enter that until later, but let's just say I change this to 85. There we go. 75. There we are. So now I'm buying the 75 call, which is just at the money, selling the 85 out of the money. And notice the volatility, the vega is a positive number. So the volatility going up is a positive for this option strategy because, again, the value of the option will go up. You could sell it for more than you potentially bought it. Volatility dropping is a negative. Don't worry. Yeah, I'll go to the positions window. Absolutely. So volatility dropping, and if prices go up slowly, volatility can drop. So that is a risk. Time decay. I mentioned this a couple times, and just a few moments ago I did. Time decay hurts this position. Time decay gets very accelerated within the last 30 days till expiration. So I try to avoid holding within the last 30 days. On bull call spreads, I want to enter when I have about a 90 to 110 days until expiration. And I try to make sure I've hit my target and I'm out. Or even if I'm not hitting my target, I may book profits or take a smaller loss when there's 30 days or less till expiration, because that time value is going to be eating up. There is a missed opportunity risk, right? If it keeps going, soaring beyond the target, oh, well, you only participate to the short spread, the short strike. Another question, let's see. Do I recommend a bull call spread if you expect little movement up or down? A bull call spread would not be delta neutral necessarily. It would actually be more bullish. It would be delta positive. So I would do a different spread. I'd be more on the short side for that if I'm expecting prices to move somewhat sideways or very little. And we've covered strategies that actually profit from that. If you go back again in the Options Education Center, am I still on that? No. I went into this particular bull call spread, but there are other strategies that address that. So definitely look at those. Anyway, the one other thing you got to be careful of is the type of option you're trading. Anytime you sell an option, even though this is part of a spread, it doesn't matter. You have early assignment risk. And that means when you sell an option on a stock, it could be called away at any time. Even when it's out of the money, that sometimes happens. Okay, it doesn't seem to make sense, but it actually has happened to me personally. So I know it can happen. It doesn't seem to make sense whatsoever, but for some reason, somebody wanted that stock out of the money. And it may have been to cover short. I don't know. But that's, yeah, an early assignment risk is what you have. To avoid that, you could trade European style options. What is a European style option? Those are options that can only be exercised at expiration. Basically, you find those on index options. So if you're using an OptionStation Pro, instead of a stock like AEM, I would say $SPXW.X, but that is an index option, not a stock option, and it's European style. And you can just look on the websites for the different exchanges to see what are European versus US style, or sorry, American style. American style options, you find those in ETFs and stocks, they can be exercised at any time. You also have to be careful with dividends. Okay, dividends are not collected, versus a call position or versus a covered call position. So, when it comes to the options, though, the calls may be affected by dividends going or stocks going ex-div, meaning that they're ex-dividend. Okay, so they may drop or move by the amount of the dividend. So there's different risks out there by putting on these spreads, obviously. So first of all, we need to figure out what strikes we want to choose, when and where. Well, you could buy out of the money calls, and there's good things for that. The premium is very cheap if you buy deeper out of the money calls. However, the deeper you go out of the money, the more movement you're going to need for that particular security to reach maximum profit. And the probability goes down. When it comes to trading, especially in options, we want good returns, but we also want a high probability that we can get that return. And a lot of people try to do what's called lottery tickets. They buy deep out of the money options, and they think there's going to be a big move and it'll pay off huge. And it's called a lottery ticket because it has about the same amount of odds of winning. Not very good. So you could use in the money options. Oops, sorry, went too far. In the money options have a high success rate, but you don't make as much profit when you use an in the money option. And the short option has a high risk of assignment. So you got to be careful of that. If an early assignment for credit spread, would your loss be limited? Yes, it is going to be limited because you could exercise your other option to offset that, but your costs are still going to be going higher because now you're dealing with the underlying securities, and there may be margin issues you have to deal with as well, depending on how fast everything is turned over. So yes, you are still limited in your risk when there's early assignment, but it opens up other headaches and other problems potentially. So a common choice is often, and you saw me doing this, where I was looking to buy the 70-75 bull call spread when the prices were coming down to 70. So it's at the money option for the long, and then selling the out of the money option. That way we get kind of a good balance of probability, profit, and potential for a win, right? The question, early assignment for credit spread, would your loss be limited as well? Yeah, there's limits on different spreads. The problem is, again, you have to deal with margin costs, and potentially if you're dealing with underlying securities and trading them, the commissions on the underlying security versus just the options commissions. So you have to understand the brokerages are all different. Talk to the trading desk to find out exactly what you're dealing with on that, because I'm not a broker, and I work for a broker. Okay. So yeah, I'm just letting you know there are things you have to worry about when it comes to trading these. There are risks, but there's also benefits. And one of the benefits is, yes, there is limited risk when it comes to these options. But yes, if you have an early assignment, there may be actions you need to take, and you are limited in your risk because you could exercise the long option against your exercise or signed short option. So again, when we use the bull call spread workspace, you could use this workspace to identify things. I mentioned before, if you go out to right here, the Options Education Center, which I put the link up for it, I'll do it again later. But if you find the bull call spreads, there it is, improving probabilities and confidence with bull call spreads. You click on the link, it'll take you to the page where obviously you see the webinars going on right now, but you can go in, explore a bit more of the strategy, and right here, download the workspace, which also has the scans involved in it. Could you set and forget? Well, you could use the activation rules in order to set up your trade. And actually, I'm going to get into that a little bit as well. So let's find another example, right? Using the scan, I can rerun it, but I don't need to right now. I'll just look for another security. Let's see, BE. What do we have here? Well, we already bounced off a little bit of a possible demand right there. Maybe bouncing. Doesn't look great. Let's see. Got something else. Just trying to take a look around to see if there's any good opportunities on some of these securities. This one's already kind of taken off. So again, I'm looking for something in a bullish trend that might be pulling back towards a demand or buying area, maybe even a little support. Still not finding it yet. I don't want to look too much, so I can just take an example just to walk through it with you. And the question was also earlier asked. I want to go over that too. Could a review a spread in the position order window? How's the amount you received reflected in the cost? Yeah, definitely. We'll look at that. I'll just use BXP as an example. Okay, because I don't want to keep going through this all day long anyway. So let's say at BXP, I'm going to do a bull call spread and execute it right around 66. And I don't expect it to go above, what's this on the weekly here? Oops. Now let's just do 75. Again, I'm making up some numbers. This is not a specific security I'm looking at for a specific trade. It's just an example. That's all. I'm going to go for the Octobers. So bring that open. Come on. There we go. And with the October, we have, actually, we're at 67.70. I'll do a 67.70, 67.50 long. And then I'll do a 75s on the short side there. So there's my bull call spread. Okay. And we have a delta 26.7 theta. Again, I'm going to go with the natural spread, which is $3, not the mid. That's a little more realistic with getting filled. Maximum profit is 450. My maximum loss is 300. Okay. If I'm looking to execute this right away, I can go to analyze as well. I'm going to just go ahead and place it real quick and see if it lets me in on that.
Order filled.
And I had order filled. You could tell because it also shows +1, -1. So I'm open on that. And it shows here as well that I have that open position. So I go over to manage. And right here, you can see filled. There it is, BXP vertical spread. So question was, right here on the BXP vertical spread, I'm in right now. Now, initially, it shows them as two separate options. But remember, this is a bull call spread, right? So I want to stay in this until there's 30 days left till expiration. Or if I hit my maximum profit, I should just get out because I don't want it to keep going and possibly give it all back. Or if it goes below a certain level, I don't want to lose too much money either, right? Well, first of all, let me just merge these two together. I'm going to grab the short call, drag it up to the long, and what do you know? It's now showing as a vertical spread. How's that? Okay, perfect. Number one, we got that going. So on this vertical spread, what I could do now is right here, close this position. So I right-clicked and I go close this position, and it brings up the order right here to close that position. But I don't want to close it right now. I want to close it if the prices reach 75, which is my maximum potential profit. So what I'm going to do is just change this to market order and put in my activation rule. If the stock BXP gets equal to or greater than 75, and again, I can do a double trade tick just to make sure it doesn't take me out early, it's going to close that position. So it's protected on that side. And I think that's right. Yeah, because it's closing. And there it is. Now it's pending. It's not filled yet, obviously, because, well, prices aren't there yet. But could I do the set and forget? Keith was asking. Yeah, that's part one. Now, part two, I can protect my downside as well, which is pretty cool. So what I could also do is go back to the same underlying position that's open. And I forget what the question was on looking at the position. Oh, how's the amount I received? Well, I didn't receive an amount. I paid an amount. Remember, this is a debit that I paid. So what it's going to show is, because this is a debit spread, it shows my open P&L right now. It shows my trade price, got it at $3. My maximum profit is $450. My maximum loss would be the $3 or $300 total. But remember, I don't have to lose the full 300, do I? Let's say my maximum profit is $450, right? I'm going to cheat a little bit. Calculator. There we go. So 450. And I was taught we shouldn't really risk more than 3 times our reward. So divide by 3, that's 150, right? So I should get out if this spread drops and I would lose $150, which means the premium would be 150, right? Because I would have to, I'm sorry, max loss, yeah, 300, I would have to buy it back for 150. So what I could do now is go to my analysis, and that's the spread right there, analyze. And I can move these along based on, not today necessarily, but again, I can go and change the dates as well, because the dates and volatility will change. Let's say this goes halfway. And I'm not going to go in too much detail of this right now, but what I can do is figure out at what price would I be losing $150. Right there, I got 170 at 64.30. Is that the right one? Yeah, long 6750. That is the right one. So perfect. So all I have to do now is go along here and see, well, I'd lose $150 in profit, roughly. Again, it's not exact right now, but roughly we'll call it $65. So if prices drop below $65, I want to get out. So again, I can go to close this position, do the exact same thing, market order, good till cancel, activation rule, and say, I want to get out if BXP again goes at or below, and I would do more research to make sure I'm exactly right with volatility and everything else. But if it goes below $65 on a double trade tick, I want to get out. And these are closing orders. I think I might have to attach it to the other because I got an order rejection on that. But I can set it up as possibly an OSO or, OCO with the one that I already have pending for the profit. So the answer is yes, you can, using those orders for the activation rule orders. You could set up your stop loss and your target. Actually, that's what I should have done, was edit this one. That's the easier way to do it. It is the pending one right here. Oops, sorry. BXP, that's the market order. Cancel the order. I'm going to do it again all at once. I forgot. This is the easiest way to do it. And then we got to wrap up. So I'll ask if there's any questions. But basically on the activation rule for the exit, you do it all at once. You don't have to do 2 separate orders. I don't know why I thought that for a second, but I do market order to exit. And I do it this way, because that way you do it all at once. Watch. If BXP either goes greater than or equal to $75, that would max out my profit, and I want to exit. Or if it goes less than or equal to $65, I also want to exit. That will be accepted because it's on the same order that way, with a market, good till cancel. And there, I don't have to do the OCO type thing. It's automatic. You got to make sure you change it to or, and it accepted. It's there. The order's pending now. How cool is that? So I do have the order set to either exit if it hits my target and max out on profit, or if it goes below a certain amount, I lose that $150 of premium, I'm protected. I don't have to lose the full 300. I only lose 150 because I would exit before all the time value goes away. That's pretty neat. That's pretty powerful that you can do that. Also, inside the Options Education Center, there is a section on activation rules and how to do what I just talked about. And there's actually there's a video in there. And of course, you can rewatch this. There it is, placing activation rules that I think Jesus did a while back. So let's see. I think I answered most of the questions that came through and talked a little bit about how to do this. Do you use automated trading strategies for options? The automated trading strategies will work on the underlying securities to identify them and alert you, but you actually have to place the options orders in yourself manually on OptionStation Pro. So it's a little different. But as I said before, if you want to access these particular scans that we have available for you, or TradeStation has available for you, you just go to the Options Education Center. You can download the workspace with all those scans and everything involved right there. They're ready for you. So that's basically what I did. I walked you through all this already, so I don't have to do all that. You can exit for a profit or a loss by simply closing out the spread. Remember, I typically do this when there's 30 days or less until expiration, just to get out. So I ran over a little bit of time here, and I want to thank everybody for being here.
Brandon, hey, we appreciate your time. Thank you for sharing all that knowledge with us, and it was great information. Brandon, again, thank you for your time, and we hope to see you again in a future webinar. And everyone that took time to join this webinar, thank you for your support, and we look forward to seeing you in a future class. Goodbye, everyone.